Hello, folks. Welcome to Market Trends. I am David Russell, Global Head of Market Strategy here at TradeStation. Great to be with everyone. Here are the disclosures as usual. And also, as usual, don't forget to go to the Market Trends blog. Go to TradeStation.com. I mean, it's the Market Insights blog. Go to go to TradeStation.com, and at the top of the page, you will find the link to Insights, which will take you to our blog, and the top story with the blue background on it about Goldilocks. Goldilocks could be emerging with the Fed on pause. That's the one you want to go to. Now, as usual, if you have any questions, put them in chat. I'm going to. I need to start adding some more stuff. Excuse me, to the zip file. There are some things that are kind of popping up now, and very good. All right, so lots of interesting things happening in the market. This is the Colombian peso, which I'm going to get to why I'm looking at that. So basically, if we look here at our article, we have a lot of things, and I think the single most important thing, I'm going to start with the American Association. What is this? AAII sentiment making me do this. That's strange. All right. So let's go at this historical sentiment. Look at this. So 24% bullish. That's the lowest level since I think May. Let me actually have it on my other screen here. So we have now a super negative reading on sentiment. This is the least bullish since May, and the bearish of 50% is the most bearish since last December. So in both cases here, we see just the extreme of negativity that is built coming in. Now, this came out yesterday, November 1st. You have to assume it was done before the Fed meeting. And there have simply been a stream of things after this Fed meeting that are really difficult to, even encapsulate all this stuff I'm seeing here. I'm going to just read through them. If we look at them here, there's a few things that I kind of covered here. But to me, all right, I'm just trying to think where to put it. ADP lower than expected. And we also saw wage increases with the slowest wage increases in 2 years. Okay. ISM missed. Unemployment fell. Orders slowed. Okay. Consumer confidence, that's not important for what I'm saying right now. But then let's look at this one. I'll be honest. Call me crazy, but this week, the single most important headline was this: productivity. Labor costs show surprise decline. The surprise was massive. So we basically saw labor costs go down 0.8%, and they were supposed to go up 0.7. That is enormous. So productivity beat by 50 basis points because of that. This is for the third quarter. We also saw some other items. The Challenger Gray job cuts increased, kind of also showing us, some slowing in the economy. Jobless claims were above expectations. Let's see, we had a little recent bump in claims being, they went down to 198,000 2 weeks ago, 3 weeks ago. Now they went back up to 217,000, which looks like the highest since like early September. So jobless claims pointing to some kind of economic weakness. So again, this is dovish. And this basically says the Fed is getting more toward being finished. So let's look at the Fed, the countdown to the Fed. This thing. And what we really see here, if we look at December, well, this is now December, we can see we went from, a month ago, we were expecting there was a decent chance 39% of a hike in December that's now been cut in half. And if you look out let's look at the March and stuff. The key thing is the Fed hawkishness is evaporating before our eyes. And we can see here, same sort of situation. So to me, this is now just a very big sort of trend that we see, kind of an increasing. You never have the pure confirmation of anything like this, but we have more and more sense that the tide has turned and the pendulum is moving in the other direction on this question of interest rates. And it's interesting that it happens at a time when we got the most bearish since last December. Look back at the S&P 500 at that very moment. It was December. Let me see. It was the most. I already went back and looked at my old data. It was the most since December 22nd of last year, which was right here. Market pulled back, and basically here we are, same sort of thing. We had this kind of low. So, I was talking about that strong momentum to the downside, but when we open a new month, it's interesting just to kind of see how the sentiment changes. I'll also say that I believe that we have less geopolitical risk now. Biden, I think it was yesterday, talked about a pause in Gaza. World opinion is at this point, kind of opposed to what Israel's doing, the American support for it. There's a lot of things here that maybe suggest that the situation is not going to escalate a lot more from here. And if it simply kind of stabilizes and it doesn't lead to something greater like an oil embargo or some kind of disruption in the Persian Gulf, and that's really the big thing. The Strait of Hormuz, Persian Gulf, something happening with Iran and all of that. That is the mega event that people don't want, that will terrify the market and cause problems. But if it doesn't happen, then we're in a situation where it's just one more fear bubble that disappears. We had debt crisis, we had a million other things that were going to be terrible, and then they go away. And it seems to be that that's sort of happening with the situation now. I mean, the kind of trouble, at the societal level, all the unfortunate things happening in Israel and across that area, all of those are not, I'm not saying they're cured, but from the market's perspective of them being able to hurt sentiment and hurt stocks and hurt financial conditions, at this point, the market doesn't see as much of that being in the cards any longer. And when you have that sort of sentiment lift at the very same time we get this, and at the very same time, I just got to say these things Paul said. Here's one thing from Seeking Alpha, but I don't even know how to, summarize it all. So he basically said wage gains are now consistent with 2% inflation. So 6 to 8 months ago, everyone thought that wages were running too high and it was going to cause inflation. And now, not only, well, first of all, that never really was clearly true. But the other thing is that the wage growth, like we saw from this, from the productivity report, that wage growth is also no longer at the point where, in Powell's opinion, it's consistent with 2% inflation. The other thing he said was that risks are now more two-sided. And I kind of pulled this out of a million different things. I went through like several articles and I just pulled out the key things. I'm not sure what I have, if I have this in front of me, but if you actually go to the Fed website, you can find the transcript of his press conference yesterday, and most of these things are in there. So he said wage gains are consistent with 2% inflation. Risks are more two-sided, meaning we're no longer in a spot where we're definitely going to hike again. Now it's a spot where we are maybe going to, or maybe not. That's what he means by more two-sided. Whenever you're in a situation, it's like, well, we're going to do this, but we're leaning in one way or another. They're no longer leaning toward hiking. And so that's a big deal. Third, he said, we're not confident that we haven't defeated inflation. We're not confident that we have. What he's basically saying is they're no longer really sure about, the inflation, what they even understand about inflation, which means they have less conviction to want to hike. And the last thing he said was, someone asked him, is it fair to say you're still leaning toward hiking? And he said, it's fair to say that's the question we're asking, which is really different from the Fed, believes further tightening is necessary or something. So basically, you have this Fed thing happening at the very same time that this fear in the Middle East subsides, and then earnings season comes out and it's not that horrible. All those things all coming together And you get these surprises that were very interesting. I mean, if you look today, what really surprised me was a name like Starbucks. I mean, I really didn't think Starbucks. I mean, this thing has been a real weak name for a while, and they come out with some pumpkin cream cold brew or something that completely reinvigorated their results. And then we saw a lot of other names that I'm going to go through, like well, Palantir was strong. Roku was, a stunner to the upside. And all these are sort of things where it just kind of suggests that things are just not as bad as people thought. Shopify right here. Um, and, you just kind of have one of these things when I mean, I think we've all done it. Something is just selling off and we sell the bottom. We basically capitulate and then it goes straight up from there. And I mean, it feels terrible. You wake up the next day like, how did I do that? And I think that that's the spot where a lot of the market is now. They're like, how did I sell Shopify at 45? They're like, how was I so negative on these things? And you just see that the negativity, you know, had peaked. And once it peaks, and then you look at the seasonality and everything else, things are more in a kind of favorable spot. So it is interesting to kind of see all these things kind of coming at the same time. Now, we had kind of last webinar, we were talking about kind of continuing to play the downside, which worked for the next session. But I think it's also, I want to just point out that we did kind of, start to highlight, especially this turn that was, coming on, with the monthly rotation. And I think it's interesting to just think in months because in many ways, November started on Monday. People kind of looked out, they saw the new month starting and we're now in that new kind of period of a new month. All the ugliness of October is in the rearview mirror, and also the Fed being gone, earnings season, holiday shopping season, year-end sort of momentum. Those factors are now what are at play. I also want to mention, so we called this one, Goldilocks could be emerging with the Fed on pause. And I think that the other thing I would mention is well, yeah, I mentioned the jobless claims, labor costs, and the job cuts. Let's take a look now technically at the S&P. What's interesting to me is that I've been kind of looking at some different levels here in the S&P. And if you look at it, there was a big weekly or monthly double bottom at 40.48 that had been kind of a level for me, but a level that I've been watching, and let me see, I know I mentioned this as a level in one of my blog posts, so 4109-ish, and it went down to 4103, which was this weekly low from back here, pretty much held that. So now I think when we look at the market, we have this sort of declining trend line, and we have this level from the August low. And if you look here, you can see that here's the August low. We're about 25 points below it. We have this falling trend line coming down. And in my view here, we're at a spot where, we're likely to see a degree of chopping, like something like this when you have a falling trend line along there. You know, I'm not sure you're going to see just a clear breakout through it and a pure rally. From my perspective, we're likely to see some kind of consolidation here and possibly a test back down toward 4,200. At this point, a lot of the overall the trend signals, none of them are all that bullish yet. The 8-day is still under the 21-day exponential. We still have a falling 50-day moving average. So at this point, I think that we kind of get this. Also, we have a 4-day move here off the lows. That's a pretty, expecting a continuation to new highs when you're so far off the lows and you have the a 4-day move. It might suggest we need some kind of digestion here. And so I think in many ways we have, a lower high, a lower low. Now the key thing is, will we put in a higher low? So I think the question here is really that, at this point, the more, the thing that maybe people are going to be looking for is from here, some stalling and weakness, and then a test down toward this level, this level here around 4,200, maybe 4,220. That was a breakout level from June, and also the support level in early October. This might be the place where people start to look. And then by that time, it will allow the moving averages to kind of line up more positively in the short term. To me, the bigger story, though, in many ways, I mentioned the Colombian peso, and I mean, this is just one, but look at the United States. Look at the Mexican peso against this is a dollar against the Mexican peso, the U.S. dollar against the Brazilian real. Um, it's interesting because a lot of Latin American stocks, China has all kinds of issues. Europe has issues. Latin America doesn't really have issues anymore. And I've been looking at some different, I don't have them on my disclosures, so I cannot show them because they're ETFs. But I encourage you guys to take a look. You can find the Brazilian ETF, the Mexican ETF. They exist. There's some things like that out there. You can find them yourself and kind of look into them. There are a series of Mexican stocks that are potentially interesting. The biggest one is Petrobras, PBR. There's a lot of others, though, like ITUB is a Brazilian bank. This is just kind of like a bread and butter stock of Latin American investing. Another one is BBD, Banco Bradesco. Another one that's interesting that I'm actually writing something about for a partner in one of the outside companies we work with sometimes is Arco Dorado, which is a franchisor in Latin America of McDonald's restaurants. And what's interesting just with all of these is if you look, they're positive on the year, and on the longer term, they're kind of just starting to see, some traction. If you look at the way the 200-day moving average is coming higher. And in my perspective here, we're at a spot now where a lot of these big tech stocks have been great, but we shouldn't forget that a new year is starting. And the other thing is, let's look at the dollar index. We have been in a period of dollar dominance, really for a long time. The US dollar, look at it in the last decade, it's really been high. But if you look at this on a long-term chart here, I mean, people have asked a lot about the dollar and everything. I recently did a study on TradingView. This is TradingView I'm showing you here. And basically what I saw was this is the Euro weekly chart. You see this falling trend line. And actually this support line should be here. But what's interesting about it is you see it had this falling trend line that it broke and then it held this support. Now the Euro is about 60, 70% of the dollar index. So to see something like this, this tells me that, the dollar is no longer really falling, is no longer rallying against the euro. And I think it's interesting also because, the question is dollar weakness. It's not euro strength. The question is the dollar ready to stop going up that it's been doing for 9 years since 2014? Are we finally at the end of the road for this move? And, if there is a time when that's going to happen, a Fed pause would be that time. So from my perspective here, it could be interesting to start looking around at some of these Latin American stocks because, like I said, they are doing far better than Europe. They don't have the issues of China. And I think it's kind of interesting. So this is something, to me, I'm telling you, not a lot of people are going to talk about this, but something is happening in these Latin American stocks. I look at some different quantitative analysis, some different, other things. And what I found is a lot of these Latin American stocks trade at valuations that have really come down a lot over time. And the other thing is, I haven't covered it in a while, but I talk about what I call the 7 catalysts of stock movement. And one of them is investor rotation. And global stocks, emerging markets, things like Latin America, they tend to have a total kind of herd mentality. And when investors start rotating into them, you can get a move that will last several quarters. And I think it's just kind of interesting to see some of these names. So I think right now, Latin America, you're not going to hear people talk about it very much. But in my view, it's starting to kind of emerge as an area of interest. Like I said, weak dollar changes a lot. But let's look at some of these individual names. I mean, the Starbucks was very interesting to me because they had a lot of history. You see this bearish earnings gap. That was one. There was another one here somewhere. And, they really were doing badly. But the thing is, a company like Starbucks, I think it's kind of interesting. Our mover of the week is Decker Outdoors. And so for me, what's interesting is that when a branded product company is doing well, it's really good. And when it's bad, it's really bad. So look at Estee Lauder. I mean, what does Estee Lauder have in common with Starbucks? They're both brands. And when a brand is gaining customer loyalty, valuations rise. They can control their pricing. That means they can control their margins and make more money. So look at ELF. Well, this company, but this one it's kind of like they've done well versus Estee Lauder. They had this pullback more recently. But most of these consumer product companies, I've talked about this a lot when I keep harping on and on about, Coca-Cola being terrible and all that stuff. But the thing is these consumer product companies, when they actually have something that's working, it can be really good. So for Starbucks, it stopped being really good. But now it might be starting to be really good again. So to me, this is actually something that could be very interesting to watch Starbucks in the next few days and see if it chops around 100 here. It's very overbought in the near term, but the question is, 3 to 4 days of kind of chopping and consolidating around this level might kind of fix that. It might also be something where we see a retracement. Maybe I doubt it will retrace 50%. I mean, if this isn't a new bullish sort of trend, it might not retrace the full 50%. In my view, it's more a question of looking for the $100 level or these highs, 97 to 99 and a half. That area in here, these peaks could be the spot where people start to look and wait for some of these moving averages to catch up. But this could be a name that could start to accelerate. Speaking of accelerating, Netflix was one that we did an idea on TradingView. If we go up here and look at our TradingView ideas. Now for options traders, this is one to me that looks very interesting. We notice here how Netflix had this falling trend line. It look also similar to Starbucks, had a gap. This to me could be a roadmap for Starbucks. Gap off of a despairing low when people thought, oh, it's terrible. And then, oh, no, it's not so bad. And then it holds. But look, that was like 2 weeks. And then the continuation. And it's higher than that today. It's up at 424. So look at, see, this pattern. We wrote about it right around here. And then, but from my perspective, a name like this on Netflix, another sort of thing. It's not a consumer product exactly, but it's a consumer facing company that has a brand. It has a defined business. People know when things are good, they're good. When things are bad, they're bad. And that could be interesting to see this coming back in play for Netflix and then also for Starbucks. Now, turning to one that's not a consumer brand, SPGI. They own, ridiculous company, I guess, but they own the S&P 500. They own Dow Jones Industrial Average. They own the indexes. So when people buy mutual funds, they get a cut. They get a cut of stuff that is based on their product. Kind of like if you go and you buy, some kind of branded product. If you go and buy like a Chicago Bears jersey or something, the Chicago Bears get a little piece of what you paid. SPGI is the same way. Now they had a strong quarterly report. And the thing is, if we are, at the beginning of a kind of market recovery, you look at this stock over time, it doesn't look that terribly different than the S&P 500. So this is an interesting sort of name that I just wanted to point out. I mean, it's not a consumer product company per se, but they control brands, and they are also in a spot where, they are the only, kind of game in town. And when things are going to be good for them, they're going to be good. And I want to just point this out. It's not on a lot of people's radar, but there's a good earnings report. It's a member of the S&P 500. It's a major company. It's not a highly traded sort of retail name, but this is sort of name also. A lot of despair down here. Again, maybe 3 to 8 sessions of sideways movement, and then maybe continuation. Affirm has a new deal with Amazon. I just wanted to point this out. I don't know much about this company. I don't really understand it, but Amazon increased their relationship with them. And I'll just say technically, I'm seeing this pattern a lot of these things that were just terrible. And now the 100-day moving average is turning higher. Look at Blackstone. Look at KKR. These are private equity firms. They all look the same. Now, of course, the S&P has a similar sort of pattern, but it's interesting to me to just see. This is why I start to think that, as we go to the new year, everyone has complained. There's been, Apple's leading everything and the Magnificent Seven. And I think that people could start to be looking at this point in time for rotation into new names. So we can actually look, we have some tools here to actually find these. You know what? Let me actually show you really quickly. I hadn't thought about that. I don't have a platform thing for today, but I'm going to do this. I'm going to very quickly go to a new radar screen, and we're going to find, I'm pretty sure I've given you guys you know what? We can do it right here. Let's go to MT main. Let's go to MA tools. I've got it right here. We can go days since MA test. All right, we can change this to 200 day. Okay. And what this is going to do is this is going to show us members of the S&P 500. It's another custom indicator I've given you guys. I haven't talked about this one in a while. I'm going to reload my S&P because it has some old companies in it like AmerisourceBergen that don't exist anymore. Or at least not with the ticker ABC. So this indicator will tell you how many days since the stock tested its 200-day moving average, and it will also give you a positive if it's above and a negative if it's below. So you can look at the name. Here's the name like Carrier. They had a good quarter, I think. They do the HVAC. But it's interesting just to look at this. AMD came off the 200-day moving average. Now, I mentioned that because, once stocks have been down here, there's not really a lot of entrenched longs to be selling quickly. When things come off levels like this, there's not a lot of pullback. There might be a pause and some very minor digestion, some inside days, some tight consolidation. But a retest down here might not happen for some of these. So that was Amphenol, which is a company that makes wires and cables. But I want to just point out, this is a tool I've given you guys. We haven't talked about this probably in like a year, but days since MA test is a custom tool proprietary to market trends. I don't know anyone else who has ever used this, but I created it for you guys. And I do find it useful. Go looking through this list. Let's take, here's one. Garmin. I mean, my Lord. But this thing is nuts. I mean, this company had a really strong quarter. And if you look at this thing over the long term, when this thing is good, it's good. And when it's bad, it's bad. And, it's interesting to kind of see. Let's take a look here and just add volume to this, because this was a high volume sort of move. This is an interesting one also, getting near a new year. The question is, if you're a long-term investor, is Garmin a strong name next year? That's how people are going to start to think as we get into this part of the year. And if you look at this, I mean, you can see we had a real, most volume on this name. This must have been a quad witching, or I don't know what this was back here, something strange with a high volume. But you're talking about a really significant volume sort of move here. And I think there's a 52-week high on this name, right? So basically, strong quarter. And this was on my list also of a name to look at. I'm not even sure exactly what their situation is, but I've looked at a company like this, and I can tell you, it's on these companies that people keep saying it should go out of business, they have no future, and they just keep coming back. And so this was an interesting one as well that came on my list. But again, you can see it just came off that 200-day moving average. So this tool is available to you guys, and you might want to check it out. But the thing about saying like a firm is that, you have, it's probably a high multiple, one of these high multiple Cathie Wood kind of stocks. Let's go now to a fundamental grid and take a look at it. Let's look at AFRM. All right. Well, it has a negative PE ratio. It's not that overvalued though. I mean, you look at it, it trades for, 4 times revenue. That's pretty high for a financial company. twice book value. It's a pretty high multiple overall, I think you could say. But the question is if the Fed is done, does a stock like this, is this the beginning? And with the deal with Amazon and everything else, does a company like this go bankrupt? They just signed this deal with Amazon. Or is this the moment when you look back 5 years from now and it's up a lot? And I think that these are the kind of moments that are like that for a lot of these names. And as we near the new year, and I just cannot emphasize so much, this is a new epic now if the Fed is done. We've had different epics in our financial history that you go through. You go through this, the COVID epic, and then you go through the inflation epic, and now we're going into the post-inflation soft landing epic. Maybe. I mean, that's what the market seems to be looking for. And it's a question of the market will price things in before they happen, run with them for a while, and then if they're not true, it'll just go right back the other way. But if it is true, it'll keep going. But the thing is that this is what the market trend is that is emerging right now. And that's what we try and do in this webinar. We try and look for those market trends. We try to look for the things that are emerging. And I believe that well, I won't say I believe, but if you look at historically, there is a chance that we are going to see the rally widen from the big names to the small names, from the stocks like Amazon to the stocks like Affirm, from the stocks like Amazon to the stocks like Shopify, which I think is also just a major long-term secular growth name that has just been completely beaten to senseless. I mean, a stock like this is a long-term growth stock. They are integrated in a lot of e-commerce. Another name that's on that, now this is not an actively traded name, but GLBE has a partnership with Shopify. This is one I have on my list because also, if you look at the growth on this, I mean, this thing's growing like 40, 50% a year. It's very expensive, but if we see that peak in interest rates, these sort of smaller, more random names, so revenue growth, see 50%, it trades for 11 times revenue and PE ratio. It doesn't even have positive PE, but it has, this is a very high multiple sort of stock, but high multiple growth stocks, rates start coming down, the VIX, just doesn't go up anymore. These could be those sort of names that we look 6 months from now, we look back and we say, of course they were going to go up. It's obvious. Now, I'm not saying anything's obvious, but the thing is that in hindsight, I'm going back and I'm trying to kind of see from previous rallies and previous sell-offs what signals existed. And in my view, these are the sort of things that we have seen if you look back at other moments in history. The smaller names, the names that will benefit from lower interest rates, from the Fed being done. Again, the market will price this in and run with it before it happens. And then once it's happening, it'll be over. Once it happens, the market's already been there, done that. Sell the news. Remember, buy the rumor, sell the news. Okay. Roku, I didn't read really Roku, but I know they had a really strong quarter. I'm not as sure about this name, but it's another sort of hyper growth name. There was a day when this stock was a darling for momentum investors. There were days when this was one of our top symbols on a monthly basis. Back here at this point in time, I remember in 2019, I would do articles about the top symbols in a month. And Roku occasionally made that list. And I mean, it's very volatile, but again, it's a high multiple growth stock that can benefit from lower interest rates and lower volatility. DoorDash, again, they did surprisingly well. All these stocks, what do we see? We see the 50 days above the 200-day, and they've basically had gone nowhere for like 6 to 8 months. Patterns are playing out. Now, another one that is less of that case is PayPal, but I mean, they had what was also potentially a pretty strong quarter. And, this could be one that has like a real kind of turnaround potential. So I want to just kind of mention that. I mean, everything about the chart is ugly. There's not any kind of, I mean, there's not a lot of clear signals here. You have some decent volume above. You can make arguments about this being some bullish patterns here. You have like this kind of hammer pattern. It rallied, pulled back. Um, you know, I'm not sure exactly what the situation is with it. It's a complicated company that has a lot of things with, well, not complicated, but they have their own internal metrics. You got to spend a good 15, 20 minutes reading the earnings report, digging into the press release to understand it. But I will say that for the first time in many quarters, PayPal was not a disaster. And maybe that's all that matters. Maybe just a company like this that is a major, sort of cornerstone of the American economy or the global economy, that at one point, can you believe that at one point this was one of the maybe 15th or 20th, this was in the top 20 most valuable stocks by market cap in the S&P 500. And look at it. I mean, it was at one point. I couldn't believe how high up it was in the rankings because I would go to my radar screen on my TradeStation platform. I'd go to something like somewhere here I have market cap, probably under fundamentals. I used to always be looking at this. I look at the S&P 500, and I would go to like market cap right here, and I'd see, wow, I can't believe that PayPal is like such a big. They were like bigger than J.P. Morgan or something at one point in time. I mean, they were huge. They were, in this ranking, they were somewhere in this ballpark. I remember that back during COVID. So the thing is, they've lost so much that this could be one to be looking at. And as we go into next year, again, when people are, you know, looking for opportunities with a new year coming and stuff like that, this can be the kind of name that comes back from the dead. It's also interesting to look at Target. I mean, this company just, I don't know. Brian Cornell came out and said that people are only spending on groceries. Meanwhile, Starbucks came out and had this great quarter. So I think Target, though, honestly, that guy went from hero to kind of like, everyone thought he was like this next visionary. And honestly, I think he's been pretty flat-footed for the last year or two. He doesn't his ideas have not worked out super well, but the fact that he's saying negative things about his business, earnings are coming up on the 15th. He's on CNBC saying, "Oh, no one's buying anything," meanwhile, other, retail sales have been beating estimates. Maybe it just tells me that Target is just losing market share. Maybe that's what it says. So, kind of interesting. All right, Palantir. Now, in my perspective, Palantir is giving some interesting sort of situations here. So many of these patterns are similar. It's not exactly the same as Netflix or Starbucks, but it's similar. You have a rally to resistance. But look at Netflix, and I think Netflix again should be a guide for what we might see. Consolidate in, this kind of rallies against a short-term bearish momentum. We had the falling 21-day exponential, rallies against it, holds, turns that higher, and then it goes. But what do we see? We had the moving average cross right here, the 8-day cross above the 21-day exponential. That's a potential signal. And now let's look at something here like PLTR. The 8-day is still under the 21-day. This could be something that we want to, sideways movement potentially, and then maybe continuation. So I do think that is this potential setup, Palantir, Starbucks in particular, are showing these patterns. Potentially Shopify. I'm not sure exactly what to make of a name like this. This one might be a little bit different because I don't know. It's interesting with the holidays coming and everything else. This one strikes me that you might not see as much consolidation. I'm not really sure why I didn't dig into it as much, but to me, this was one that never made any sense. I mean, it had this bullish earnings report here, and the market just hammered it. So this one might not look back or have very much consolidation. I did want to also mention one thing that popped up in my view here, which was that, I continue to kind of, say things that are kind of negative on energy, but they said um, refineries are undergoing seasonal maintenance more slowly than expected to avoid gasoline inventory builds. So the refineries are kind of bearish on gasoline. Kind of interesting. So we've been, I've talked a lot about, I think, is a a bearish setup coming in energy, and oil is trying to bounce here, trying to hold like 80, and the energy ETF XLE is having a good day. But from my perspective here, we might be in a spot where we can be thinking about some downside sort of behavior in the XLE and in energy. In my view here, we're at a spot where you have some pretty clear support around 84, and we have this kind of drop, and it might be a question of looking for something like a 50% retracement of this drop. That might be the sort of thing that we want to see. And if you look at this here, go to our Fibonacci price retracement lines, Fibonacci price, kind of go from this close down to this close. That would put us up around 88 and 88 and a quarter. So I'm still, kind of thinking and contemplating, downside in energy. It's chopping here. It's not ready to just have the bottom fall out. But from my perspective here, this has, a lot of patterns that could, it could end up being, kind of bullish. Who knows, breaking out to new highs. When you look at the data we're seeing in the inventories, in my perspective, that it doesn't seem like there's as much potential as there used to be. Once the oil spigots turn on, the inventories build. And so I think right here, we're in a spot where oil might be setting up and it might consolidate for a month here. And then we might get a nice sort of move like this. That's what I'm I'm hoping, but that's kind of what I'm thinking. Because like when oil, it can this energy ETF, when it moves, it can get these really just, just a bottom fall out of the thing. And so I'm kind of thinking we might start to see something like that in the energy space, and I'm putting it on my radar and I'm watching. But I think this might be a sort of thing that we want to be kind of planning for, or at least considering looking toward. All right. Well, this is just something that this chart, it has some kind of study of financial conditions getting super like um negative. It's a Goldman Sachs financial conditions index, and I think it looks at a combination of stuff like interest rates, but also credit spreads and things like that. Probably the VIX. If we look at this, we can actually see that when this black line is high, it means things are bad, or they're tight on financial conditions. Usually the market moves the opposite direction. And this is just something I saw that they talked, some guy on Seeking Alpha had noticed how it was, hitting some peaks. And so the thing is you'll notice this was when the Fed was getting most hawkish late last year. This looks right around October when the market bottomed of last year. And if this starts to move lower, the black line, this would be also a positive for equity. So I want to just point out that this is another thing that kind of fit into that calculus, what I was saying. I think that people should watch the dollar index because, this is not something you trade in anywhere or anything. But if we do start to see the dollar trend lower, I think we need to look at it on the longer term. Like this is the monthly chart now, the dollar index. And like I said, long term, it's in a downtrend. It's been it's like, going back to the 80s. But if the dollar just made like truly made a lower high on the monthly chart, we could see a period of months of downside in the dollar, like we saw here. We saw here. This is a nice downside of the dollar from last year, right? And so I think right now, this is something that needs to, kind of remain on our radar. I mean, the European economy is not doing particularly well, but for one reason or another, the dollar is in a secular, downtrend. I suspect it's because of globalization diminishing, and it has more to do with the fact that as the United States becomes less reliant on imports, and they'll start to actually see the dollar becoming less important in the world, but that's actually good for the American economy. So I want to just point, I mean, I'm not going to get into these giant historical things. The question is, if we're seeing a long-term high on the dollar and it breaks lower, it could last for many months, and that would correspond exactly to what I said at the beginning of the webinar about Latin American stocks. Downside in the dollar would be potentially positive for emerging market global stocks. But the thing, like I said, is China has all these trade wars and these, tit for tat over semiconductors between Biden and Xi and all this stuff. But no one is talking about Latin America. Europe has issues with whatever's happening. I mean, they have some real economic problems, with their energy transition and the things that happened because of Ukraine war and that stuff with German industrial factories and stuff. But like I said, Latin America is kind of this, you look at the three major places people can invest: Asia, Latin America, and Europe. Latin America has the least issues. So, all right, let me see some of the points in my webinar. Let me know if you guys have any questions here. So I mostly mentioned these things, but these are, some interesting sort of points here. And I kind of highlighted this level, which, I thought we might want to be looking at. We rallied up above it today, but let's see if we chop and fill into it. Of course, Apple reports after the bell. Current bounce. So I said the current bounce may lead to the August low or the falling trend line. So again, the level on the S&P is this level here, this August low, and the falling. So we're kind of at that falling trend line, and we have this resistance here. Remember, this was the high from the summer of 2020. This is the magic level that we tried to hold, then it became resistance, and boom. So remember, we have this gap down post-Fed. There's a lot of issues here. And I think that between this kind of, if you look at the high from mid-October versus the low from early October, we're right between those two levels. And I think that, some consolidation in here is what a lot of people will be looking for. We'll see. I mean, it could just tear right through the trend line. But I think that, from a short-term trading perspective, up 4 days, this is the thing we want to kind of see. Of course, we have the jobs report tomorrow as well. Honestly, judging by the jobless claims, judging by the ISM, had a very negative in the ISM manufacturing. It actually had a very negative employment in sub-index inside of it. So I would not be surprised to see a weak, jobs sort of number tomorrow. But I don't try and guess on anything like that or even understand it. I don't think the jobs number even matters as much as the wages. And the other thing is, it's kind of like, if the jobs number is weak tomorrow, that's going to basically give people even more sense the Fed's not going to, hike anymore. All right. I'm just looking down. I covered most of these things. All right. What's also interesting is the Treasury Department comes out and they basically increase the size of their auctions less than people had expected. So that means less Treasury issuance, which means yields won't go flying up as high, as fast. That's interesting. I mentioned oil refineries. So also into consumer confidence. Again, we continue to see what's interesting is they ask people, what do you think about a bunch of, your spending, inflation, all that stuff. And we have seen more and more that people are more bearish about their neighbor than themselves. They say, I think things are terrible. Well, how are you doing? Oh, I'm doing pretty well. And to me, that is actually a very positive environment, because what it means that we have a false perception of the world, which is overly bearish. And I think that's it's the polar opposite of 2007, when everyone thought everything was fine, and in reality, their houses were upside down and their credit cards were blowing up and a total disaster was happening. This is the complete opposite of that. Now we see strong job growth. We see repatriation of business in the United States. We see a narrowing of the trade gap versus GDP. All those things are improving. It's the opposite of 2008. And people are now more negative than they were in 2007, 2008. So to me, that is for the market a positive thing, because it means that people can come around. And I was in college back in 1994, 95, so I wasn't really paying attention to the stock market. But I think if you look back at that point in time, there was a lot of negativity around the same thing. And I think that I continue to think that looking back to 1994, the soft landing of 94, 95, and the bull market that it launched, I continue to think that remains a template for us. And if you think back, 1994 was about 10 years after the Reagan bull market started. It started in 1983. 10 years later, you have this in the middle of the secular bull market, you have this weakness. Well, our current bull market started in 2013 when the S&P broke out to new record highs. We are 10 years in the middle of it, and we have this kind of 10-year angst. And what happens though if we have the soft landing and rates have peaked and they come down and all the nervous Nellies come off the sidelines? I continue to think that we have that potential for a strong sort of flow into the market. I think that the negativity, like I mentioned, so I think that people want to kind of, I think, just be aware of the fact that it's a crowded trade and a lot of people are leaning in the bearish camp. And as that migration happens, it migrates from fear to neutrality to euphoria, and we are still somewhere on the fear side. So let's see. Also, the home prices better than expected. And I gotta say, we've been saying that the home builders are, to me, one of the most obvious sort of potential beneficiaries of rates having peaked. And I think that we have to kind of, bear that in mind, the different home building stocks. There's few industries that have as positive, fundamental sort of setups as the home builders right now. And as interest rates ease lower, these guys are going to, be in a spot to benefit from it. And what's interesting is that home prices are not falling despite interest rates shooting so high. So again, when prices don't fall when they should, that's telling you something. It's telling you the supply demand is favorable in that, environment. This is interesting. Tom Lee, he just said we could break a doom loop, which is kind of what, he's talking about now. I hear the decline of odds of the former rate hiking. Also, okay, if you look back on October 9th, Gartner put out a report saying the PC market was going to recover. And then Intel and AMD appeared to confirm that in their quarterly reports. This guy, Jeffrey Gundlach, at Double Line, sees interest rates falling as the economy slows. We'll see. I would actually say I tend to be in a spot now where we're going to have this sort of like perfect slowdown, because you have a spot where, we see it, like I said, in the jobless claims. We saw it in the, these different slowing numbers that I was pointing at. But the thing is, if it lets the Fed take its boot off the market's neck, then that's what we want to see if we, if we do want to be on the long side of equities. I'll just say that if we look back at 18 months ago, imagine you have like a little Volkswagen Bug and you got 10 people that want to jump inside of it and everyone jams in and you can't do it and the whole thing's a disaster. That's what the economy was 18 months ago, of orders and demand hitting the industrial sector. That's why people were getting massive raises and prices were through the roof and there were bottlenecks. Now we have a Chevy Suburban and we have like 2 people that want to get in, which means now we can have a nice steady drive. And that, I think, is the way we need to think about this. If you look at the various things, if you just Google S&P PMI report, just Google, look at it and read the PDF that comes out. If you look at the ISM, all these things suggest that we now have capacity in place. Prices have come down. The orders have moderated enough that things can now ramp nice and steady. And as the housing sector improves, it will drag the other parts of the economy along with it. So these are the places I see, playing out. The other thing is very interesting to see gold and silver refusing to rally despite what we're seeing with the weakness and the Fed pausing. And to me, that also says there's less fear. I've been just hoping, that we'll get a rally at some point in silver, but we're not. So, I mean, I've always liked silver. It's kind of, it can be thrilling when it works, and it's not happening. And I think that's actually very bullish. The other thing is a lot of these things like gold and silver, even copper, they have a big connection. to the clean energy trade, which, we've been talking about for several weeks now, just the disaster of these stocks. One of them, I think, had just, Solar Edge. I mean, they just have been completely, we've been, talking about it for a while, but, I think that, that's also something that is going to weigh on things like silver. Now, I would almost say, and I don't know this yet, it's going to be hard to do, but here's something I want you guys to give you guys some homework if you're curious. Okay. I believe that most people did not appreciate the connection between solar energy and housing. Which is what to say is that, where I live, I actually saw a bunch of new houses went in, and a bunch of the new houses had solar panels. But, if you just live in your house, you're not going to just necessarily go and stick solar panels on your roof. But when new houses are getting built, that's when they're putting these solar systems in. So it's going to be very interesting to see as home construction picks up, will we see these solar stocks that have gotten annihilated start to come back? Now, the thing is, when you have sell-offs of this magnitude, these things don't just come back from this quickly. But this could be something to start thinking about, a few months out to see if maybe this train wreck kind of improves. But anyway, I just wanted to throw that out. I just thought about that now as an idea. It could be interesting to think about. But for now, I think the key thing is the home builders themselves. Also, some of the real estate investment trusts have really taken a beating. And, there's one stock that used to be, well, actually, there's two I want to talk about. American Tower, they own a bunch of cell phone towers. And another one is DLR. DLR owns cloud computing data centers. It's pretty interesting to see the XLRE, the ETF for, real estate, hitting a 52-week low not that long ago. And then look at DLR. It hasn't made a 52-week low in a long time, making this higher low. Just something also to be kind of having on our radar. All right. Looks like I have no other questions. Those are the main. Let me just make sure I'm not missing anything. Well, I had some patterns here that you guys can kind of look at on your own. To me, I think Occidental is one I'm looking at on the bear side. In terms of energy here, to me, this has a lot of signs of something that's just petering. And look at this pattern. Now look at Solar Edge. Look at that. Look at how it just hugged the 200-day for like a couple of months and then boom. So actually several months. Now look at Occidental. So just saying. You guys can check out the signal scan. And I want to also mention Deckers is kind of interesting because they have an interesting business model that they've used some new technology for their marketing. And, it seems to be kind of paying some interesting dividends. So just another one to kind of, maybe have on our radar. A lot of these are names that are not in the S&P 500, but maybe one day they will be. And I think that Deckers they're one of these companies that somehow their products are working, their marketing is working. And when a consumer product company has that in its favor, it can be a really powerful tailwind. Mover of the week, I look for a kind of, random company that you wouldn't have otherwise thought of that is a legit company, but is just kind of off your radar. Usually I look for members outside the S&P 500. So, we basically have Apple tonight was important. Payrolls tomorrow. I'm not sure that payrolls will be a particularly important catalyst after the Fed meeting, though. And after today's, like I said, the productivity report. After that productivity report, I'm not sure that you're going to see that much importance placed on the payrolls report. And then we start to get some more Fed speakers next week. I don't have a complete list, and they often just pop up without warning. But it could be interesting because we could start to hear all these hawks start sounding a little less hawkish, and that could, be potentially, or who knows, maybe they'll say some hawkish stuff. The market will pull back. It'll give us that chop down to the early October low around 4,200, and then continuation. But it's a lot less active next week. After Apple and after payrolls, things quiet down a lot. Then the following week, we get CPI. So that's what I'm watching here for market trends. I'll see you guys again next week. Have a great day.